Hi guys, this is Craig, the options linebacker. This is the weekend report for Sunday, May 23rd. Now the first thing to notice here on this monthly chart, this goes all the way back to say the early 90s, is that the bull markets that we've seen tend to last a little bit longer. In fact, they're quite a bit longer than any bear market. So here's the 2000 to 2003 bear market. Here's the 2007 to 2009 bear market. You can see that they're short and quick. They are historically always like that. Typically they last about 18 months and then they're done with. Now the problem that bear markets produce is that they're so painful and they're so difficult to trade for so many people. Most people lose money during bear markets that memory lingers for quite a while. You can see that we had the same thing happen after the rally in 2003. And then we get into 2004, and all of a sudden we start to show weakness and things start to turn around again. And all of a sudden the hand wringing comes out. I remember it very distinctly back then in 2004. The market was very soft, everything looked very weak, and everybody expected it to go straight back down here to S&P 800 again. Well, exactly the opposite happened of that. This is where that wall of worry gets built, where people just expect things to turn around and go down, and they don't. And it leads to short covering, and that provides the fuel for the last legs of the rally in this case. The other thing to notice is that tops in the market are very, very complex. Look at how this top in 2000, we came up and made a parabolic high, then we dropped quite a bit, scared everybody to death, and then we came right back up to actually a higher closing high in this case. And then from there, things kind of fell apart. Well, we actually had the same thing happen in 2007. We came up here in the summer and made a parabolic high, and then we dropped off the cliff in July and then roared right back up in October and made a new high from there. And from there, things fell apart as we took out the prior swing low. So based on some of those observations, first of all, we're seeing that this 14-month-old rally is a little premature to call it dead just yet for a couple of reasons. First of all, it's a little too short for a bull market. Now, some may say it's just a bear market correction, but I think we're still being influenced by the memory of this great recession that we called it here. We've been in this market for 14 months now. I still think we have a little bit left to go. I think there's still some unfinished business. Second point here is that we've just come off once off the high. We haven't built that complex top yet that would tell us that things are starting to change. Now, when we get into the weekly chart, we get a lot more information that's more critical to us here. So we can see that we've gone through a 5-wave pattern to the upside. Now, even with all the fireworks that we've had over the last couple of weeks, the prior swing low down here at 1044 has still not been taken out. What I mean by this is that there's still not a change of polarity. We're still having higher highs and higher lows. In the weekly chart, we have not seen that change of polarity. This would look like this if we were to do something like that. That would be a change of polarity, and that would almost scream for a lower high to be put in, and that would at least have a very deep ABC corrective wave, or perhaps even make this turn into a full 5-wave series to the downside. And that would produce that complex top that we're talking about. But the actual turn in the market is literally months away. That's the difference between whether or not we're going to do a full 5-wave series to the downside and perhaps even retest the lows from March of 2009, or whether we're going to turn at this point and start heading higher with a new 5-wave series. That decision point is months away. We really don't have to worry about that right now. For right now, I think the bigger issue is whether or not the charts stop here, and they've actually stopped right at the 38% retracement of this swing from the beginning of July to April here. This swing here, the 38.2% retracement of that, is where the chart stopped on Friday. So we could see the end of this swing and then a little pop higher. I still think we're doing an ABC corrective move here on the weekly chart. I don't think that any rally that comes up here will lead to new highs. I think at some point we'll probably fail around 1150 or so, perhaps up to 1180, and then we'll have to make that corrective C wave. So that's the immediately bullish or more positive outcome scenario. The second scenario that we covered is the one where we actually take out that prior swing low, and that would again probably set up a deeper pullback, probably up to 1180 or so, and then the C wave would kick in, or wave 3. Again, way too soon to get into that just yet. Now the third possibility, and this is based on the fact that we've got this broadening pattern here going on. You can see this megaphone setting up that we've drawn here. The volatility is increasing, and normally that is a bearish move, at least in the short term. We could see something unfold that you can't put it past this market the way it loves to move. We could see a drop all the way down to the 50% retracement of this entire March rally up here, all the way down to around the 950 area. So we drop about 130 points additionally off the S&P right now, and it can unfold in a hurry if we don't get any resolution to this European credit situation. That would set up probably a very, very strong rebound back up here. So the faster you drop, the faster you're going to bounce, just like what we saw back here in 2009. Now, really kind of the bottom line of what I'm saying is that after the bottom in March of 2009, you can see that we've had some strong rallies, but you can also see how this is sort of bending over. And what we're doing is really we're working our way into kind of a sideways pattern here for the short term. How deep that goes, we don't know at this point. A lot of it depends on the current market sentiment, but the one thing that we discussed when we were talking about the monthly chart is that we've got to go back up and make that complex top if this is going to roll over and form the end of this bull market. We haven't done that yet, so we have some unfinished business to the upside yet. The question for the short term is how low we go to probe those lows to find support before we do get the rebound. Now, moving down to the daily chart, you can see that Friday did something very important, which was to take out those prior swing lows from the crash. Remember, a couple of weeks ago, what we did was we went back and looked at the history of all previous crashes, and those generally marked the low of the reaction. The crash marked the low of the reaction, but in many cases, the bottom was retested and slightly undercut. And a slight undercut can be very important, can lead to much higher prices, at least in the short term. The reason is because too many new bears go short right on the breakdown of those new lows, and they chase the move, and then they have to turn right around and cover, and that provides the rocket fuel to get things moving higher. Now we also have some bullish divergence showing up here in the MACDs. Now we just wrapped up another profitable cycle for the month of May, and it was a difficult month to trade, but there was a couple of things that we did defensively that worked out for us really, really well. The first was when we got up near the top here with a very, very low VIX, with such a frothy market, it's just very, very unstable. So what we did was we bought some out of the money long puts down here at the 108 level, just as cheap crash insurance. And those cashed in big time as we sold those out right near the bottom of the move. Now, in addition to selling the iron condors, we also play directional trades too. We're not a one-trick pony. We're always looking for high probability swing trades that don't set up very often, but when they do set up, they're very high probability. One of these is the RSI2 that we played, entered around the red line here as the price was coming back up. We did have a good signal here, and we covered it a couple of days later when the RSI was back up to around the 70 level on there and scored a really nice gain. And then on the flip side, as soon as we got the rebound, we have a cross of the 8 and 21. That's another swing trade strategy that we execute, as the cross occurred right here, and then you take the pullback to the 8 EMA, which is the red line. And so we've been long on the SDS, which is an inverse stock, and are off to a nice gain in this one as well. Be careful in this volatility, folks. We'll see you next weekend.